What if I told you that everything you think you know about money and the stock market is about to get flipped upside down? Picture this. Wall Street in chaos, money flying, traders shouting, everyone chasing the next big thing. But beneath the noise, there's a myth so big most people never question it. It's the idea that if there's a ton of money sloshing around the system, it's always a good thing for stocks. People think more cash means more buying, right? They see the Federal Reserve printing money, pumping liquidity into the banks, and they get ready to back up the truck. They figure all that dough has to go somewhere, and that somewhere is the stock market. So they dive in head first, thinking it's a can't-miss, one-way ticket to Profit Town. Booyah! More money, more problems? No way, they think. More money, more gains. Imagine a giant pipeline full of money, but the valve at the end is rusted shut. The pressure builds, but nothing comes out. The banks are hoarding it. Corporations are sitting on it. Even consumers are stuffing it under the mattress, metaphorically speaking, of course. They're all too scared to spend or invest it. They're worried about the future, about a recession, about the next black swan event that nobody sees coming. So the money just piles up, going nowhere fast. So what is this monster lurking in the shadows? It has a name, folks. It's called a liquidity trap. Say it with me. Liquidity trap. It sounds complicated, but it's not. The Federal Reserve, our nation's central bank, has a toolbox. Its main tool is the interest rate. When they want to get the economy moving, they cut rates. Lower rates make it cheaper to borrow money. Cheaper money means companies expand. Cheaper money means people buy houses. Cheaper money means people buy cars. Cheaper money means the stock market usually goes up. It's like stepping on the gas pedal of the economy. But what happens when they cut rates all the way to zero? What happens when the gas pedal is already on the floor, but the car is still stuck in the mud? That, my friends, is a liquidity trap. The Fed has done all it can with its primary tool, but it's not working. People are so pessimistic, so scared of losing money. Businesses are so pessimistic, so scared of losing money. Even free borrowing isn't enough to get them to invest or spend. The cash just piles up in savings accounts. The cash just piles up in low-yield bonds, earning next to nothing. The normal transmission mechanism of monetary policy is broken. The engine is flooded. We've seen this movie before. Look at Japan during its lost decade in the 1990s. The Bank of Japan slashed interest rates to zero, but the economy stagnated for years. Companies, burdened by debt from the bubble years, refused to invest. Consumers, facing deflation and job insecurity, refused to spend. All that liquidity the central bank pumped into the system just sat there, like a puddle of water that won't evaporate. After 2008, the Fed took rates to the floor and started quantitative easing, printing money to buy bonds. There was unprecedented liquidity, but recovery was painfully slow. When a liquidity trap takes hold, you have to throw your old playbook out the window. It's a whole new ball game, and the rules are different. The classic buy the dip strategy? Forget about it. In a normal market, a dip is a buying opportunity because you expect the economy to bounce back. But in a liquidity trap, every dip could be the start of a long grinding slide. The market can stay irrational longer than you can stay solvent, and it can stay flat and lifeless for what feels like an eternity. Your favorite technical indicators can lead you astray. That moving average crossover? It might just be a head fake, a bull trap. Those RSI extremes lose meaning when the market is trading on pure fear. The market's rhythm is gone. It's no longer a dance, it's a brawl. You're trading on sentiment, and sentiment is stuck in the mud. The relationship between different asset classes breaks down. Normally, bonds go up when stocks go down. With rates at or near zero, bonds offer pathetic returns. So there's no great rush to buy them. Cash is king, but it's a king with no power because it earns nothing and loses value to any tiny bit of inflation. Even commodities can't get a bid because industrial demand is weak. It's a world of low returns and high anxiety, where everything seems correlated to zero. This is why so many traders get wiped out. They keep fighting the last war. But the market is never wrong, it just is. In a liquidity trap, the market is telling you that the game has changed. Your job is to listen, adapt, and protect your capital at all costs. Let me paint you a picture. It's 2011. The dust from the Great Recession has settled, but the air is still thick with fear. Fed rates at zero, QE in full swing, money is everywhere. Enter Action Andy. Andy thinks liquidity equals buy. He loads up on leveraged S&P ETFs. He buys call options on high-flying tech. Every dip, he buys more.
The Fed has our back! You can't fight the Fed!
He's all in, betting on a V-shaped recovery. Now meet cautious Kathy. She reads the same signs differently. Zero rates look like desperation to her. QE looks like a symptom of a sick economy. Earnings are sluggish. Unemployment remains high. She reduces position sizes. She buys high-quality, dividend-paying stocks. Consumer staples, utilities, toothpaste, electricity, essentials. She's playing defense. For weeks, Andy looks like a genius. He's gloating. Kathy's portfolio is mostly flat. Then Europe blows up. Sovereign debt crisis. Fear spikes. The market plunges. Leveraged ETFs get obliterated. His call options expire worthless. Margin calls flood in. In days, his account is a smoldering ruin. He was right about liquidity, wrong about sentiment. Kathy weathers the storm. Dividends keep rolling in. A cushion. When fear fades, she slowly deploys capital at lower prices. So if cutting rates to zero doesn't work, what else can the central banks do? They bring out the big guns. The bazookas, quantitative easing, forward guidance. QE prints money. QE buys government bonds. QE buys other assets. The idea is to force down long-term rates and push investors into riskier assets. Stocks. Forward guidance promises low rates for a long time, trying to verbally coax confidence. They are trying to shock the system back to life. Sometimes these bazookas work, or at least they seem to. QE can definitely inflate asset prices, even if the real economy doesn't improve much. It creates an everything bubble: stocks, real estate, cryptocurrencies. You're not riding a wave of genuine economic growth, you're riding a wave of artificial liquidity. And that wave can pull back just as fast, especially on taper hints. The market becomes addicted to the stimulus. The big problem is that these tools have limits and unintended consequences. They can create massive wealth inequality, rewarding asset owners while wages stagnate. This can lead to instability, another risk traders must factor in. If rates are already at zero and the balance sheet is bloated, what ammunition is left? They're pushing on a string, and eventually, the string breaks. So here's your playbook. Zero interest rates, massive QE, stagnant economy, fearful sentiment. You have to change your style. First, reduce your risk. Use smaller position sizes. Avoid leverage like the plague.